video walkthrough of Upwork and our trade on that. I will be talking about sort of Upwork from its IPO, and then we'll get it down into the details of the trade itself, and then how it ended, which was really the most interesting part. So I'll X out of that. And on the right side, what I have is notes that we're going to make as we go through the video. And on the left, I will be covering the chart work. So let's get started. One of the first things that I want to point out, and the reason I've sort of zoomed this out and it looks a little bit crazy, is on purpose. So just looking at it from an overall point of view, what and I do this when I'm developing edges, and I do this when I'm studying the markets. I'm doing this when I'm sort of coming up with new stuff that I feel that I could add to my toolbox or leverage, and make that edge a source of my daily income from the markets. So what I see here is we get the IPO day action, where basically the stock doesn't really do anything, and what stands out to me overall is this particular price bar, right? And this particular day on Upwork, which sort of seems like it changed everything about the stock. And now again, just to hammer the point home, what was this? This was the highest volume, right? The highest volume since IPO day, for starters, but it was also the highest volume ever, which we call HVE. So it's important to understand when we present these, what we call characteristics, or what we call winning characteristics. These characteristics have been studied by me, by other folks that are part of the service, where they do deep dives themselves, come up with examples, build a chart book, and sort of build their own confidence in what this edge, or what this characteristic, if it's a good one, if it's not a good one, right? How do you go about developing it? You do a lot of chart work. So what stands out to me on this particular chart, going from this bar onwards, is one of the first things. This was the highest volume ever, highest volume since IPO day. Now, the second obvious bar that we see also shares the same, which is the highest volume ever and the highest volume since IPO day, right? And also, what the other one that we look for is the highest volume in over a year, right? All of these mixtures. Now, the other thing that we look for, why did this happen, right? Why did this happen? And on both instances, it was earnings catalysts on this particular name. So if a stock is exhibiting such a volume signature, there's almost always a reason behind it. You won't see these randomly pop up out of nowhere and we see a surge in volume that the stock's never seen before. There's always a reason behind that, the liquidity that is showing up. So I wanted to start with sort of the big picture, what I see, and you guys can make notes on this side, or on your notepads as you go through the video. But this is really from a characteristic point of view, or something that we look for in the markets. This is sort of the only reason, or the first reason, that an Upwork would be or could be in the ecosystem of stocks that you track, right? Now, this stock went up basically from 14 to 63, or 30 to 63, and it exhibited these particular characteristics. So that's sort of the big picture point of view, and now we will dive into sort of the recent action that we saw on the stock and how that particular trade recently ended, which was fairly quick, which is probably the most interesting part in this video. So I'll now zoom in. We can sort of get started. Let me just get this right. There we go. So again, the reason that we had Upwork on the TL Gappers watch list is for this specific reason, which is the HVE, highest volume ever. Stock, moves up, holds, respects 25 level, does a rally, respects 30 level, does a rally, comes back in, continues holding 30. This area holds 35, goes to 60. Build top side respect for 60. Basically, at this point, and I remember this day very clearly, I had a position from either the 30s. I had a position from the 30s. We rallied up, and I remember these particular days. So that's the first point that I want to discuss, is when ranges widen. So when ranges widen, that is in motion on the charts. When we trade like this, very narrow, very controlled, very, we're going up and down and up and down. It's a very controlled action when we compare it to these two particular days, right? These 2 days exhibit emotion on the charts. And when price gets emotional, what happens to our equity curves? So let's say this is just the date, and this is your equity curve, right? If you're trading if you're always trading stuff that's being emotional like that, up one day, up the second day, but then close down well off of its highs, at least 13 points, that's a huge percentage swing. Your equity curve is also going to be very emotional, right? But when you trade stocks that exhibit tight action, and you could place logical stops if you position at 30 where it's coming back into support, coming back into volume support, right? You have a tight logical stop at this point, and you know right away if it needs more time or it's going to work for you, right? And that's really the essence of achieving something like this. You're still going to have these. And we had these, I'm recording as of July 18. We just had one of these the past week. If you didn't really react quickly on a Tuesday or Wednesday of the week and you waited till Thursday, Friday, you likely saw one of these, right? That's okay, but that's much better than this or trading this sort of action. So I want to clear that up. When ranges widen, that's in motion, and this is what your equity curve is going to look like if you're trying to anticipate or trade such action. And this is exactly what we don't want in the markets, or don't want from an equity curve point of view. The next concept that I want to cover is when charts go into a particular basing pattern, and this is something that I've been implementing in my analysis a little bit more over the past several months, is once a stock enters a base, which is basically a base is when a stock enters the first down week that it has. The first down week is the start of a new base. off of highs, right? So this made a high of 63.88. We have a down week. Now it's start of a new base. And when you're in a basing pattern, so this is your top side of your base, right? At that point, now we don't know if this is just going to go and take it out right after 1 week of rest. If it does, good. If it doesn't, then you get this stuff, right? So once you enter a base, the expectation within a base is one, there's going to be emotion. A base building process, if you think about it from a supply and demand point of view, and let's just forget about charts for a second. When a chart enters a particular base, it's at that point, it's a negotiation that at this point, someone slapped it down, correct? Now, there's an imbalance of buyers versus sellers at the top of the base. That's why price came down. When you're within a base, the imbalance, basically a new basing structure, what it means is you're building demand, or you're still in that. Now you enter a phase where you're building new demand for this particular chart. So once you enter a base, the first expectation that you have is there's going to be emotion. When there is emotion, what do we watch for? We watch for tightening. And I'm writing this down, going really slow, and that's all on purpose because I want you to understand all of this. Even if you watch it on 2 times, that's perfectly fine. We watch for tightening action, right? And the reason we watch for tightening action is tightening action shows us that emotion is going away, right? So when we get this sort of, that slap down, this is probably a 18 to 20% range. I'm just guesstimating. When we get that sort of range, right? Emotion shows on the chart, and at this point, you don't fight. You don't fight price. So what happens is if you try to attempt to trade this, and I know and remember exactly getting a lot of questions is, what if this just turns back up right to new highs and just goes crazy without you? Well, so be it. Our goal in the markets is to just see a rising equity curve, right? It's our goal in the markets. When you deposit money out of your trading account into your bank account, the bank is not asking you, was this Upwork that you traded? If so, we'll deposit money. Or was it this particular name that you traded, right? The bank is not asking us what we traded or what we did. So our goal is just to see this happen, regardless of the name, regardless of the ticker, regardless of the story, regardless of anything. Our focus is to execute edge and do that repeatedly. Do that again and again. When you see your edge, you execute it with size. You see a rising equity curve. You scale into strength. Have your sell rules. You get out, move on. You do that again and again will allow you to compound. So getting back to, so the expectation within the base is that there's going to be emotion, and we watch for tightening action. So tightening action tells us that that emotion is going away. Within a base, there's basically, or once a base starts, at the top of the base, it means there's an imbalance of buyers and sellers, where sellers are heavy. So we have the first down week, right? And then we begin a base building process. And then this is the only thing that we're watching for. I'm going to erase all of this and keep going. How do we know if within this base pattern, rather than waiting for 63.88 within a base, right? How do we know if action is tightening? One of the ways that we talk about, and we call that the launchpad, right, is where the KMAs, the key moving averages that we track, are bunching up. So when the KMAs are bunching up, which is at this point, right? At this point, this is within the base pattern. At this point, they were tightening up. This is within the base again, right? The KMAs, the key moving averages, are tightening up at this point. So these are potential spots. These are potential spots where we see, or where the way we look at it, or the point of view that we form, is that when KMAs are bunching up, that means that price, right, on a 10-day basis, 21-day basis, 23-day basis, 50-day basis, 65 EMA basis, is sort of has a average or a similar average, right? Prices on a 10-day basis closed at this spot. Price on a 21-day basis closed at this spot. Average 23-day basis maybe closed at this spot, right? 50-day, 65. So we're calling that basically the ingredients of a launchpad. Now, specific percentages, the exact criteria, what we're how we define it, we're not going to discuss that. That's mostly a sort of a business decision, or you could say to keep that edge sort of exclusive to TL, we won't be sharing the exact to the decimal criteria for these. So again, we're talking about we're within a base, and now how do we identify tightening action? And one of the ways that we could define tightening action is this particular characteristic that we look for. Once we identify a point of interest, right, this is basically what we did in this case. You guys remember we talked about Upwork at this spot where we basically said we're watching for a move above 50 on volume, then respect to build for 50, and then we'll see how it goes from that point on. Clearly that didn't happen, and we got a down drift back within the base. Now the other thing that I want to discuss is, so that gives you your tightening action. Potential spots for tightening action can be defined with the launchpad criteria, okay, which is basically KMAs bunching up. You could do that visually. You don't need the exact ingredients, but that's sort of, because you see that visually where KMAs are starting to bunch up. Those are potential spots where emotion is going away from the charts within a base pattern, and we could potentially get directional movement in a stock. The other thing that you want to watch for within the base is some sort of volume anchor. Now, I have to be a little bit careful when I say that, and this has to be like meaningful volume. This shouldn't be the Russell rebalance type of volume, which was this particular day, right? This shouldn't be IPO, like the volume we saw on Dash, right? Which is basically insiders can now sell stock, not that type of volume, not lockup expiration type of volume. Meaningful volume where when you go on a 65-minute chart or a 70 8-minute chart. You see some sort of equal spread or some sort of spread within the volume throughout the day, not a closing stick that just closes like that, and that accounts for 50 to 70% of the volume for the day. Some sort of equal spread throughout that particular day is how I define volume anchor. So in this particular case, I'm going to go ahead and erase the annotations. This particular day, it was this day where something might have happened, upgrade, downgrade, whatever the case might be. Now we have some sort of volume anchor. If you take the close of this day, just draw a line straight through. We have a volume anchor within the spacing period. In this area, we saw supply show up. In this area, we basically saw demand show up for this particular name. We're within a base. So we're expecting a motion. We're expecting this. This was a sweet spot. It didn't trigger. So we got more emotion because we're within a base. And then we got our volume anchor, which is basically this demand bar showing up. Now that we know that demand exists right near the low of the base, right? Some folks I know that have developed edges, they just look for this within a base and they would attempt to sort of buy it here and then in anticipation, and then add through as it goes, builds up a trend. That's one way to go about it. If you want to do that, go ahead and do a deep dive. Go look at bases from the past, 10, 20, 25 years, build a chart book, do that research, and have confidence in it. Because if you don't have confidence in what you're executing, you won't position size. If you don't position size, you won't perform, right? So confidence is key to doing anything in the markets. If you want confidence, you have to study your edge, right? To study your edge, you have to go back, which is basically historical studies, right? Which leads to a chart book. Again, I get this question a lot, like, what do I do? How do I develop an edge? Well, first thing is you need confidence. Then you need to study your edge. Go back, do a historical study, build a chart book, and this gives you confidence. There's no shortcut to this. Once you have confidence, you can position size when you see your edge. When you position size properly, you can perform. So, for example, if this is an area where you see your edge, and you start to sort of build up a position in this area, right, or on this right side, then you need a lot of confidence at that point because the stock's really nearing the 200-day, and you really need to, you've done a historical study, you know that stocks tend to base this way. You refer to your chart book, you develop a precedent or confidence. You go ahead and put on size, and you add through, build on a bigger position, and then you get to perform. So that's sort of the loop that just repeats itself from edge to edge. It's easy for me to say it, but really the best way to go about it is you actually going in and charting these yourselves and doing that, because that's what I'm doing in my off time, right? I could post a chart, I could post 100 charts, I could post the whole chart book, but at the end of the day, you can't borrow conviction, right? So let's get back on track. For this particular video, basically that's your supply, start to base, that's your demand, which basically says it's a potential base low, right? So we talked about two things, launch pads in this video. We talked about volume anchors, right, within a base. Don't mind my spelling. And the third thing I want to emphasize on is weekly charts, which has been a point of emphasis for me to sort of see the bigger picture on some of these names. I'm going to quickly flip to a weekly. So from a weekly point of view, you could clearly see that we have demand at this spot and we have demand at this spot. On our dailies, these were the two earning bars, right? And the gap ups that we saw. Price builds a bigger base above the 40-week line. So the overall, from a weekly point of view, we used the 10-week and the 40-week, and we held the 40-week line on Upwork as it's building that potential base. Now, this particular chart, the base depth is a bit of a concern, which is why I feel that we are seeing this sort of slap down on the particular name, right? The other thing is the weekly accumulation and distribution count that I've sort of started paying attention to and studying a little bit more. This is a William O'Neill concept that Ross covers in the Leadership Blueprints course. If you've taken that course, you know exactly what I'm talking about. Basically, the gist of it is when a stock enters a base, calculate your accumulation weeks and your distribution weeks. And if the count within this particular base doesn't come out positive, the base might be faulty. That's the gist of that concept. So I've been looking at, from an overall trend point of view, obviously when we break the 10-week line, that's the real obvious way to start. But the first week down is the start of a new base. Daily shows us the emotion a little bit more, but the weekly sort of gives us the overall trend, and the 40-week line sort of held as it propelled itself to new all-time highs. So I've been using the weekly a little bit more. I've been using this concept a little bit more as well. So let's revert back to the daily chart and now discuss entries and how we manage this trade. So basically, the chart was of interest for me at this particular point. Ideally, I would have liked to position at the respect of that 45 level. So price came in, right? Price came in this area, basically respected the 45, still below average volume after that demand anchor, right? Price is holding this level. This is your volume anchor within the base, right? Price rallies up. The volume's fairly low. I was sort of, at this point, it shows up on the KMAs bunch up scan that, or the launchpad scan, right? Sort of you keep this on your radar. This is likely, stays as it builds its base. It stays on the gappers watch list as well. So you see this developing where it starts to hold a 45 level. That could have been a point of interest. Now, there might be other names at that point that are a little bit better, right? Since this was still top side respect for 50, bottom side respect for 45. Takes out 50, doesn't hold 50, comes back in and continues to hold 45. So now we've built this where the RS line's trending up, especially in this area where price moved down on the S&P 500. The RS line started to stabilize. That tells me that this is start of outperformance or potential outperformance, right? Starts showing RS days, and now we see an upward trending RS line. So I keep it pretty simple with whole numbers. So respect for 45 on a down day, respect for 50 on the top side, basically tells me this is some sort of control action on the top side and the downside with a volume anchor within the base after we saw supply come through on this particular day. This is a point of interest. We develop a launch pad, goes above 50. If you enter here, price violates 50, you take your paper cut, right? Take your paper cut. Comes back in, and I entered on this particular day was my entry area. when it went through that 50 spot again, and the volume on that day was obvious. It was huge. When we compare it to the average volume on a 20-day or a 50-day basis. So volume came in, price went up. The next thing I wanted to watch for was respect for 55 to build, right? So if price is breaking above 55, which was a positive, came back in, it broke 55. So position, and I like to place single positions. There were RS days in this area. If you take a look at it, the thesis was built. We have the KMA bunch up. We have the volume anchor. Everything's sort of lining up for this name. We see the rising RS line, right? So my position was at 50, and my scale, or the first point I scaled at, was violation of 55, right? So I scaled at the violation of 55. That was my scale 1. For example, in this particular case, I put a sizable position on. It was about a 25% position for me. The reason I didn't really size it up, I try to oversize it at this spot on purpose, because I saw it was a clean break of 50 on that particular day. And then after scaling the violation of 55 in this area, I scaled it down to 18, right? And then it really zipped to new all-time highs. At this point, the plan was to see if it could stabilize above 60 or give it some sort of chance to come back to 255 and build respect for 55. So I was watching these two spots, which were clearly taken out this day. So this particular day we'll discuss in a bit. My second scale 2, was violation of 60 and no respect for 60. And at that point, I reduced the position down to 12%, from 18% of my portfolio. And then when it came right back into 55 and violated, basically it showed no respect for 55 on this particular day. That was my scale 3, and I called it quits. And I said, position is now closed, and that's my trade on violation of 55. And I move on to the next chart. Because now let's quickly discuss this action a little bit and then wrap up the video. So this action on this particular day, one of the things is the reason we emphasize the daily routine is exactly because of this sort of action. And this can happen on any particular stock. The reason does not matter why. The reason that does matter is if you're prepared for such a situation when it happens, right? So me coming into the session, I had a plan coming in that it's either going to respect 60, the next day do in the wick up and out, or it's going to come in, violate 60, and I'll go from 18 to 12. So I did go from 18 to 12 on this respect to 60. And early in the session, if you guys check the smaller frames, undercut 60, rallied up, right? And I don't really get flustered at that point. I don't say, oh, I shouldn't have sold. But as soon as it undercuts, that's my plan coming in, and I scale down. And then it just so happens it's completely rolled over later in the session. Now, having that plan, having a plan or a daily routine, just it takes, once you get it down to a habit, takes no more than 30 to 40 minutes for you to prepare, even if you're working full time, whatever the case might be, to sort of go through your positions and say, if this happens, I'll be doing this. If that happens, I will be doing this, right? Very simple, to the point, You review your positions and have a plan, so that when price exhibits emotion, you have a plan rather than you start hoping at that point, right? If you didn't cut stock at 60, or it came to 50 and you say, oh, it's already down, 9% for the day, can't go down anymore. Well, it did go down. It went down 18% that day in a single session. So it's important to have that, and the daily routine allows you to achieve that. It takes no more than 30 to 40 minutes a day to do the full daily routine, and it takes no more than 10 to 15 minutes to actually do a position review of your current holdings and have a plan for each particular position. So I'll wrap it there. I hope I covered a slew of concepts. Basically, we looked at the overall Upwork picture. Then we went down the basically anatomy of the base itself, right? What the action within the base, what volume anchors are, how a base begins, what the expectation is, what launch pads are, how do you position in to a name, how do you scale out of a particular name. The daily plan is very important. Also, we talked about a little bit about, what's an edge, what does it mean, and things of that nature. So I hope you guys found this useful, and I will try to do a little bit more of this video work, not only because it helps you guys, but it sort of helps me reason out what I'm doing, and then when I'm making these, I sort of see reasons on how I could get better myself, as a trader, and continue evolving. So I'll leave it at that. I hope you guys found the video useful. I'll see you guys in the next one.